Thank you, Philippa, and I can resonate with a lot of what you said, and hopefully I can make some cross-references as well in my presentation. My wife told me when she looked at the program and she looked at the time when I presented, "Husband, that's very early. You better come in with 2 trays of coffee and shake hands and make new friends." So I'm very glad and happy that you made it at that very early hour. I start actually with 2 thanks, and I normally don't express that at a presentation, but thanks for Andrew that you re-invited me. 4 years ago, I had a presentation about the state of the mining industry, and we weren't too kind and quite critical on a lot of points. So I thank you for the courage to having invited me back. I don't know if you're going to be kind and gentle today as well, although it became quite popular in terms of bashing CEOs and mining companies of late, and probably for the right reasons. I also would like to thank our investors in the fund that they actually stuck through the down cycle, or a lot of them, and now what we regard as an upcycle, and haven't lost the belief in the industry and the returns the industry can deliver. And I would like to make 2 credits. The one to my colleague Douglas that spent hours and hours and hours on the data mining of what we're going to show to you. And to my daughter, my 6-year-old daughter who wants to become a gold miner. I thought 4 years ago we were maybe a little bit too complicated, so sometimes it's good to simplify messages and reflect them. I got 3 daughters. The one wants to become a doctor, which is very laudable. I love that. She will do matric in 2 years' time. The other one wants to become a conservationist, and I think saving animals is a good thing. And the youngest 6-year-old wants to become a gold miner, and her favorite series is Gold Rush on National Geographic. So she knows what is a wash plant. She knows what pay dirt is. And we can maybe talk more about that. So she said to me, "Daddy, I'm based in South Africa. It's the end of the year. And we got more important things to do than sitting in the cold in London. It's the end of the school year. We go to these lovely plays and year-end functions." And she said, "Why do you go to London? It's far away." And I said, "Look, we need to talk why we do not so well in the gold industry." She obviously sees me, and sometimes I'm a little bit tense and I'm a little bit frustrated. So I said, "Look, I'm going to talk about a few things. The urgent need for the industry to implement a new mining blueprint, and why the big producers need to reinvent their business model or face extinction." And that's a very serious message, and I will get to that. Obviously, that didn't resonate for a 6-year-old. So we actually decided, we scrapped that. We look for the bare necessities. But bare necessity versus bare necessities, it's a very easy going title, but there is a very serious message behind. We are convinced that, I'll show you a few charts, that if the industry, and I'm talking in particular about the leaders of the industry, the top mining companies that are supposed to be the role models for the rest of the companies and the market to attract the capital that the industry needs, they need to change. And all the stakeholders need to focus on bare necessities. You see Baloo the bear and Mowgli there in the background. I don't know how well that comes along. Because if we do not focus and deliver the bare necessities will come along. And based on a business model that we think is unsustainable and is not working, they face extinction. So what I'm talking, and I maybe go back, Andrew, of what we talked about 4 years ago, and I give you a progress report on the criticism that we had then. Then I'm going to go a little bit in more detail about what we regard as bare necessities versus the bare necessities. And for the change that we looking for, that we need for, and just want to maybe end up with a cheat sheet for the management team of what we think the next generation of gold miners needed. 4 years ago, we called the fellowship of the ring has been broken. And we focus on about 10 companies in our sample. When we look at the large cap producers, they produce about over 30% of the global gold production. And when you look at the picture, and if you include the horse in front of, I think, is it Gandalf there? I'm not sure. No, Gandalf is in the front. If you include the horse, it's also 10. But the fellowship to us is actually the entirety of who is involved in the mining sector, the stakeholders. These are the mines, the shareholders, very important, but also labor and the state. And we tried to put that into context. And 4 years ago, we came to the conclusion that this is a very dysfunctional fellowship and it has been broken. And I just want to maybe give you two charts that are relatively concerning when you look from a shareholder perspective. The return since 2002, and we kind of like did December 2002 as a point of departure because that's when the last bull cycle actually started in earnest. The return for shareholders, when you look at the S&P TSX Global Gold Index, has been 28%. And quite frankly, that's bloody appalling. That's over a period of about 14, 15 years. And no wonder, the industry cannot attract serious investors from shareholders. When you look at the gold price has been 230%. It's that discontent of investors is also reflected in a derating of, for example, the price to NAV multiple. It's been through good times and bad times, through cycles, up cycles and down cycles. It's been always relatively stable and was moving around the mean. And since 2011, we saw a continuous derating. So the questions have to be asked, why is that? And what's wrong? And how can we change that? That's where we were in 2013, that fellowship of the ring that has been broken. And we look at the shareholder there at the very bottom of the entire graph. Labor had a very strong run, but was still kind of like stronger than the gold price, the increase in labor. And that's a very simple reason. Between 2002 and 2011, we saw the biggest investment cycle in the industrial industry in history. And there was an enormous amount of capital that was chasing a very limited amount of skills, resources, equipment, etc. And hence, it wasn't a surprise that the inflationary pressures, the cost of labor and all that skyrocketed. And so was government participation, meaning in taxes and royalties. And it's a normal function of companies that potentially generate more tax, have to pay more tax, but also it's a normal function of, call it sort of like the greed, the appetite of governments when they see someone is actually making money. It's also a function that the industry sold itself in a very bad way by focusing on cash costs, implying, look how profitable we are here. Fantastic. So that was 2013. I haven't mentioned the executive pay, but that was also exponentially higher. And I think that went up the nose of a lot of shareholders where they looked at the return that they achieved with their investments, with the capital that they provided over that period of time, and what the CEOs carried home. But it's not here to bash executive pay, but it just shows a little bit the disconnect that sort of like occurred in the industry. And that's where we are right now. I can't see it here on my screen here, but you see that the shareholder return has been absolutely appalling compared to the share price compared to gold. Labor came down since 2013, and that's also a function of the investment cycle imploding. So hence there was a lot of capacity available. Labor got cheaper. There were a lot of retrenchments, etc. The government participation stabilized on a relatively high level, but we think if the cycle continues and the companies increase their profitability, hopefully that is also about to change. And the total CEO comp still remained, compared to the point of departure in 2002, relatively high. Very interesting to observe. We went through all the number, we did all the number crunching, and it's mainly a function of the increased commodity price when we looked at how some of the compensation increased since 2002. Just maybe a quick outlook. We expect the royalties and the cash taxes actually to have stabilized, but it is a trend when we maybe talk in a few years' time that we expect to increase again as a function also of the appetite of these domiciles to increase royalties. Often mining is one of the very sources of revenue, and you can't just pack up a mine and walk away and go next door like you can do that with a retailer and a telecom company, for example. And so cash taxes we expect to increase, royalty potentially as well. I want to put that also into context, shareholder returns with labor. We do expect labor to stabilize as a function of the global investment cycle that probably will not get traction over the next couple of years. Thankfully, I think there has been a lot of capital discipline by the large mining companies. Gold mining, they just have to deal with the effects of the entire investment cycle, the likes of a Glencore, Rio Tinto, etc., what they spend, the BHP Billitons, because it will have an impact, because it's a competition for scarce resources. So we expect labor to be relatively stable, not being an inflationary factor. Shareholder comp, that is to anyone's kind of judgment. There are good guys and there are bad guys. There are companies that deliver, and there are companies that don't. In principle, and I will get to that, there's nothing wrong being paid a good salary if you deliver. If I put that into context with the free cash flow that's been generated by the industry, 2012, when we talked here last, excuse me, it was minus $112 an ounce. Very appalling, while shareholder comp was $4.50 roughly per ounce in 2012. That came down in 2016 to $2.50. So you could argue it went the right kind of direction. It's also a function of the share prices actually being at a much lower level in terms of the option plans than in 2012. A great development was the improved cash flow per ounce that is now at $172 an ounce. That is very laudable. A very sore thumb is actually the dividends, and when we compare that per ounce since 2002, it's actually declined dividend per ounce of 10%. And this is something not to be happy about and something that has to change. Again, I'm talking about sort of the large cap producers. When we spread the net, we cast the net a bit wider, you see sort of like the red bars are the big producers, and you see that the comp, we call it also now the total comp, that's the CFO, the CEO, plus the board, and the board is very, very critical in that equation as well, is slightly higher. That's also a function that of the large cap companies, of course, produce far more ounces per unit, and sometimes the medium-sized producers and the smaller ones can be quite naughty, as it often treated at times as a lifestyle kind of like venture, unfortunately. Is the CEO compensation too high? That is Maya B that asked me to put in that slide. Is it too high? No. Or maybe yes. It is a function, it depends from company to company. So we are not bashing CEOs by saying you're getting paid too much. But what we ask is structure the pay differently. It's not a function of the gold price, but you as the board, as the non-executive directors, You have to sit down, you have to have performance targets, and they have to be achieved, and then you can say, right, you're going to get paid for that. And it's not a function of the gold price. That's not in the hand of the CEOs and the board. So a roadmap going forward, because quite clearly we talk about something that became very dysfunctional. And when we look at some of the scorecards that I will go into it just now, you will see that if there is not a fundamental change in the approach how these companies are run, they will face extinction within the next 5 to 10 years, unless they're going to be bailed out by a gold bull market, which we don't hope. We hope for a gold bull market, but not for the latter. We mentioned 4 years ago as an ideal business model, and that is a business model when we screen all our investments, 80, 90 companies that we follow closely. The most successful amongst those companies, the ones that deliver continuously shareholder return and improved key ratios, stick to that very simple blueprint. And some of the large caps don't. Stick to 1 to 5 operational assets. And remember, I'm also talking about the Barracks and the Newmont, and that might be quite revolutionary for some of them. Focus on an IRR of 20% under a low road scenario. And the low road scenario for us is a gold price around sort of 1,100 to 1,150. If you don't make money under those circumstances, you shouldn't be in business. Free cash flow potential of the assets that you operate under a low road scenario and a very short payback time. And free cash flow potential means you need to print cash, you need to generate cash, even if the gold price is not higher. If the gold price goes up, that's an additional bonus. Otherwise, it's not a sustainable business model. Self-funded growth, or a very high funding potential. Self-funded growth is critical because when we look at the dilution since 2002, it's actually appalling. And if we would look at the ratios in the scorecard based on a per share basis, I would probably sit in the bar with a few whiskeys and have a couple of debates. They aim to be debt-free. I think it's incredibly important to be debt-free, have cash in the bank. Mining can be a very uncertain and volatile business, and cater for that. There's nothing wrong being debt-free and have cash in the bank. For shareholders, sustainable and high dividends. And I think that's also why a lot of shareholders go into those relatively cyclical companies. We also want to have a payback that is worthwhile sitting there. And we ask for management compensation strongly to be linked to performance target by achieving economic key ratios, by achieving production target, by also kind of achieving soft goals in the sort of like environment that you operate. And I kind of like pulled out a scorecard from an independent research house. And when I look at the sample that we compare these companies that produce about a third of the global gold production. And I'm afraid there are a couple of South African companies in there as well, and they probably kind of like worse than sort of the average. But production growth over the past 80 years has been 0.4% per annum. And when you think about this is sort of like after the biggest investment cycle in history, that growth can be regarded a little bit as mediocre. The cash costs came down about 12% from the peak at 675. All-in costs at 925. But you can look at these numbers, free cash flow yield 4%, div yield less than 1. But if you have the choice between a range of sectors and a range of companies in all, from banks to industrial companies to Bitcoin to, TMT, etc., is this something that really attracts you on a sustainable basis? And our answer is no. And that is really, really looking for bare necessities. So what we actually think the only way going forward for these big companies to survive and to create a role model and the dynamics in the industry that you need is literally creative destruction. And it's hard because, we talk about little empires that have been built, about CEOs, management teams that reign like these kind of assets and these companies like Little Kingdom. It's not going to work. The history of the last 20 years has demonstrated that you cannot deliver on that business model. So we ask to follow and implement that mining blueprint and literally break up these companies. If we are a company that has maybe 20, 25 assets, break them up, focus on the best 2 to 3, maybe talk to your esteemed competitor in the market and said, maybe we should bundle our 2 or 3 top assets and create a real top class companies, and it's all about focus. And the rest has to be regarded as marginal, and that dispose. So break up the companies just actually to survive. Reinvent yourself or face extinction. And maybe to summarize that again, and some miners are a little bit simple-minded, but they love that kind of stuff. Break that stuff up. You're not going to survive. History, key ratios, investor sentiment, your own track record is against you. That has impacts on the tier 2 and tier 3 companies, because if you focus, you also have to dispose. And that creates chances for a lot of the medium-sized companies or for new companies that will pick up these assets and most likely will do a much better job. And again, for those companies, that maybe operate currently 3 or 4 assets, the message is a very simple one. Focus on your top assets between 1 and 5 and dispose anything else, and someone else will probably do a better job. Some other kind of criteria, as I said, dispose of anything that is not matching sort of the hurdle criteria. Rely on realistic exploration success and don't just blow the capital that is being given to you by shareholders and drill holes. And keep the dilution to an absolute minimum. Companies that created maximum shareholder value stuck to that rule, keeping the dilution to an absolute minimum, and work with the capital and the cash that you generate. Shareholders are very guilty in that whole equation because everything happened under their watch. Shareholders are the owners of the company. They should be vocal. They should be vigilant. They should be active. They should engage with the board, and the board then again, as a custodian of the owners of the company, the shareholders should sit down with management and say, look, that's what we have to do. That's what we're going to do. We want to see that and that strategy implemented. For shareholders, also do not go and gun for growth alone. Focus on profitability. One of the big mistakes over the previous cycle is that shareholders went aggressively for growth and were demanding from management and the board to go for that. And sometimes these guys have to be strong enough to say, no, we're not going to do that. Our aim is actually to create maximum value. And also focus on a business model that is working under a low-rose scenario. The question is then, when you focus on it, are you an investor or are you a speculator? And don't be a supplier of financial heroin. And that's been one of the curses of the industry over the past 15 years, that it was relying on shareholders, actually the capital market, to provide money for one capital raise, the next. That's also why a lot of the balance sheets of the medium and small size producers look so healthy. Most of them are debt-free. That's also a function of these never-ending capital raises. But it won't be good, because it will not install the discipline that you need from management. There are bare necessities for the sector as well. Resistance to change. If the management teams, and it is a very, very serious and well thought through demand that we have also on behalf of a lot of our shareholders, if they resist to change, and if they continue in the old ways that they have been over the past 15 to 20 to 25 years, they will face extinction. Shareholder complacency, I mentioned the aspects where the shareholders need to play a far more important role. Financial heroin, if the gold price goes up, people get very jittery and very happy, and companies will be back in the market with a heartbeat to go the easy route. bear traps, the old ways. A bear trap could be for that kind of like resistance to change a gold bull market as well, because obviously that will bail out a lot of the management team and will continue and will reinforce the complacency. ETFs are toxic for the industry. And it's not per se a bad investment vehicle, but it's, first of all, like speed dating. It's not kind of like establishing a relationship with a company. And ETFs don't talk to companies. And companies need to have a dialogue with the owners. ETFs are passive and quiet. We don't like that. I want to finish off with a cheat sheet for the next generation of management team, because I think the whole sector needs to change away from the old faces. You can go to conferences and you will see the same people again and again and again. And we need a new generation of young gold managers, CEOs, CFOs that come in innovative with new ideas, focus also on running these companies as real businesses and not necessarily an option on an increasing gold price or even worse, a lifestyle company. So that cheat sheet is a kind of like reinvent yourself and your business model. Look at it as a real business as it is, and gold or silver or platinum being, by accident, sort of the product that you produce. Focus on profitability and deliver against any aspect of your P&L. You need patience and consistency. Don't focus on, the next quarter or, even the quarter sort of like 12 months down the line. Show consistency and invest in the trust that the people that gave you the money, invest in that trust and deliver. Surround yourself with hardworking and competent, innovative people. And that's creating also a culture of success. Fulfill the obligations and responsibilities to the stakeholders that you have. And that means the governments, the shareholders, but also labor and everyone else involved. And embed all these aspects in your corporate culture and align your interests, for example, as a CEO, with your pay, with the interests of the shareholders, be goal-driven. And last but not least, just put your big boy pants on and get cracking and stop complaining about the world and the low gold price and all that. It's possible. And, we'll finish off with look for those bare necessities that are really important, that will change the sector, that will change the companies. And, we get sort of asked about how we see the world going forward. I talked about an environment preferably where we would like to see a flat commodity price going forward. And of course, we all wish that this gold price would go up and go to new highs and all that, but probably to reinforce the change that is needed for the survival of the industry. That's the best one. And, but we're of the firm view that it's a very cyclical industry and metals prices are cyclical too. And we've seen a very interesting cycle that started in 2001 and peaked in 2011 and bottomed in 2015. In our view, we are in a transition to a new bull cycle. That might be a good thing or a bad thing. Hopefully the good aspects kind of like are in a maturity. But that bull cycle might be far more powerful than the one we've seen between 2001 and 2015. And a very encouraging fact is actually that the investment cycle hasn't really started in earnest. That will put a huge damper on supply, and that will force and reinforce probably also far more capital discipline and delivery. But I want to finish that because I have a very, very, very nervous, very good friend that is running sort of like a company where its share price has been tanked. And he just sent me that kind of picture before, the conference and said, give me one more mining boom. And he gets rid of all the nonsense that he's got in the portfolio. I think we will get that boom. But to really leverage from the next upcycle. We need to implement, and the large cap companies actually need to be in the lead for that. We need to implement that blue mining, that new mining blueprint in earnest, and the big companies have to be sort of like the trendsetters of that. And in order to survive, they need to force creative destruction within their portfolio, as hard as it may sound. And with that, Jessica and the team, I'm open for any questions from the floor, if there are any.
Thanks, Markus. Are there any questions, very quickly? Hopefully not. We'll have one down there. We only have time for one.
Hi, Markus, thanks for a wonderfully honest presentation. In terms of that destructive nature that you say is required of these companies to reinvent themselves, if you like, I mean,
correct.
Is that you wishing, or do you really think that's going to happen?
It will have to happen. Otherwise, you're not going to survive. When you look at those key ratios, and you see that the business model that you run is not profitable and sustainable in the long run, what are you going to do? In order to survive, you need to change.
Have you seen any evidence that they're beginning to think like that, or?
It will take time and suffering. And when you look at the de-rating of these companies, obviously, you know, that's a very, very clear signal. And if there would be a bit of more reflection, and the pressure also has to come from the board. It's not the CEO that can decide. The board actually of these larger sort of entities, you know, they need to sit down and say, look, we have a problem here. We haven't delivered. It's not working. How are we going to change that? And there are role models out there in the industry, and they're even amongst that sample of those 10 companies that show that it can be done, and it's measured in profitability ratios. It's measured in the share price performance against the gold price. It can be done. So if you do not deliver, and if your share price and your key ratios are way below par, then you need to ask yourself these questions and have a very hard look into the mirror. And as I said, if you do not change, you will face extinction. Because I don't think that the shareholders will be patient enough to deliver that financial heroin as they did between 2001 and 2012. I don't think they will be daft enough to do so, or willing enough.
Great. Markus, thank you so much indeed for your comments and also for that question. Thanks so much.
It's a pleasure.
Thanks a lot.
Thank you.